BIS Commodities. Just taking a look at a few things at the weekend review. Let's just take a look where we closed out for the week. We'll start in the grain markets. Corn closed 14 cents lower at $14.83 in the July contract, and we've seen Dees corn close 19 cents lower at $4.81. Moving on over to wheat. July wheat closed 48 cents lower, was the big loser this week at $6.74. July soybeans down 22 cents on the week at $14.65. New crop beans, no beans, down 5 at $12.21. Over in the meats, live cattle down 20 cents on the week in the June contract at $137.85. June hogs down $1 on the week at $119.17. And the stock market set to close here looks fairly steady for the week with yesterday's sell-off. Taking a look at the corn market, a few fundamental things affecting the corn market is the planting progress, of course, and the weather. We did come in right at the 5-year average this week as far as planting, or last week as far as planting at 59%. We're going to take a look at the planting progress next Monday night. The trade is expecting somewhere around 70% to be planted. The weather forecast is fairly open. The states that are lagging do have a full week, or the forecast is telling us they have a full week of opportunity to get the corn crop planted. The middle of the Midwest, Nebraska, Indiana, Illinois, and Iowa came in at over 70% this past week. It has been a slow week. We'll take a look at what those numbers have to say Monday afternoon. Technically, the corn market sold off. Charts look ugly, pushed down. That July contract shows a lot of support right around the 480 area on the charts. So as we take a look at this market moving forward, the funds are still holding a very large position, and in fact they're holding more than double the amount of length in corn than they were last year at this time, with probably a little bit more of a bearish fundamental aspect taking a look at it as far as carryout stocks in corn than last year at this time. So that's something certainly to keep an eye on as we move forward. Again, weather will probably be the driver over the next several weeks. Soybeans, same thing. Planting date isn't quite as critical, or perceived to be as critical in soybeans. We came right in at the 5-year average this past week, or the previous week as well, at 20%. The trade's looking for a bump up in soybean planting as well. Old crop beans technically seem to be bouncing in a 50-cent trade range. Volatile week. $14.50 is support in the July contract. $15 seems to be an area of resistance. The trade's still grappling with a very tight stocks-to-use ratio of imports versus exports. As of the USDA's report a week ago today, we are to import a record 90 million bushels of beans. So the trade is trying to figure out the amount of beans coming in versus the beans going out. And we still continue to sell old crop beans, as we did have a positive number again this week as far as weekly export sales. Cash basis is something to keep an interest on, or an eye on as well. The Eastern Corn Belt certainly continues to be stronger than the Western Corn Belt as far as basis. We are still looking at basis levels 60 to 80 cents less than last year at this time in the Western Corn Belt. Certainly something to keep an eye on as well. And speaking of beans, the new crop beans, if backing up and taking a look at that report from last Friday, we have penciled in a 330 million bushel carryout for next year's beans. Certainly a very optimistic report. And even if we were to whack 50 million bushels off that by the end of the summer, if that is realized, that will still be the largest carryout in the last 8 years for soybeans. So as we move forward, if we grow an average crop, we will produce a record crop following two back-to-back record crops out of South America. The million-dollar question is, will we continue to see a record demand against those record crops? So certainly take a look at those November beans. 1210 to 1230 has been the trading range, tight trading range for the last couple of weeks. I think I'd want to be a seller or a hedger on anything to the upside break out of that, and we could see a flush of funds getting out of their positions if you were to break out to the bottom side of that. Another thing to come into play with the beans, there is a very large bull spread in place, and with a lot of the fund managers looking to roll out of those positions, you could see some pressure on the front end, the old crop, as they roll into new crop. It may provide a selling or a hedging opportunity for us as well. Moving on to the cattle market, a light reported cash trade this week. Probably some cash to be traded after the cattle on feed report this afternoon yet, but for the most part we did see a light trade, $2 to $3 lower than last year. Boxes for the week were fairly steady. We've seen a little bit of give and take, but they seem to hold in here. Demand is certainly a question as we move forward. It hasn't been the prime grilling season to date. I think cash will still be the ultimate determinant as we move forward, as cash still trades at a significant premium to June futures. As I mentioned, we did have a cattle on feed report this afternoon, and the trade was looking for 99%. And we actually came in at 99%. So we were looking. Again, the average trade estimate was 99.2%. We came in at 99%. Placements, the average trade guess was 97%. We came in at 95.1%, so that may be a little bit more supported than the deferred contracts for the fat cattle market. And marketings came in right in line as expected at 98%. Really not a whole lot there to make a huge determinant, so I think cash will still be the determinant next week. Moving on over to hogs, the front end of hog futures continue to lose premium to the deferreds. We did see August test contract highs this week. August futures and October futures actually made new highs. Certainly the PED virus is being talked about. We're not hearing as much as of late. The trade's still looking at 8 to 10 pounds heavier hogs, carcass weights on the slaughter. Interesting enough, we haven't seen our kill numbers drop that far yet to this point from last year. The argument can be made that they're about to, and that's the reason we can continue to feed hogs out to heavier weight. But certainly the talk was that June was going to be the month that the big hole was in, and by the middle of May we would see those numbers drop. In fact, on the week, we may have killed more hogs this week than last year at this time. So certainly keep an eye on the kill as we move forward. If that doesn't drop, you could see a little bit more of this heavy fund move that's heavy to the long side, and hogs decide to move out. And you take a look at those deferred contracts for guys that have open hogs, it's certainly an opportunity to lock in a very profitable position. So it seems as if the funds may be moving out of the front end into the deferreds at this point, rolling their longs out, and you could make the argument they're doing that for both cattle and hogs. So if you have any questions about this, please feel free to give us a call, or if you have any questions about the grain market or any other markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525, or check us out on the web at biscommodities.com.